Dollar cost averaging versus lump sum investing. This debate comes up every time someone gets a bonus, an inheritance, or has a chunk of cash sitting on the sidelines. And most of the takes you will find online miss the actual point. Today we are going straight to the data. We will look at what research actually shows, why the math points one way but the right answer for you might be different. And I will give you a clear decision framework so you know exactly which approach to use in your situation. Let's get into it. First, let us make sure we are using the same definitions. Dollar cost averaging, or DCA, means investing a fixed amount of money at regular intervals. Regardless of what the market is doing, you might invest $500 every month into an S&P 500 index fund, whether the market is up or down. You do not try to time it, you just go. Lump sum investing means taking the full amount of money you have available and investing it all at once, immediately. The classic debate is this: if I have $12,000 sitting in savings and I want to invest it, do I drop it all in today, or do I spread it out over 12 months at $1,000 a month? That is the question we are answering. Vanguard did a landmark study on this exact question, comparing DCA to lump sum investing across US, UK, and Australian markets going back decades. Their finding: lump sum investing outperformed dollar cost, averaging approximately 68% of the time over any given 12-month period. 68%. That is almost 2/3 of the time. Why? 3 reasons. 1. Markets go up more often than they go down. Historically, the stock market rises in roughly 3 out of every 4 years. If you are holding cash and investing it slowly, you are frequently investing into a rising market, meaning the money you held back earlier missed gains. 2. Holding cash while you wait is its own form of risk. That cash is not earning 10%. It is earning almost nothing relative to equities. Delaying investment is a decision with real cost. 3. Time in the market consistently beats timing the market. The best individual trading days tend to cluster around the worst periods of volatility. Miss those days and your returns suffer dramatically. Let me make the math visual. Say you have $10,000 to invest in an S&P 500 index fund at the start of a year. The historical average annual return is around 10%. If you invest the full $10,000 on day one, your money starts compounding immediately. By the end of the year, you have somewhere around $13,100. If you DCA that same $10,000 over 12 months, $1,000 per month, your last dollar does not even get invested until month 12. The average dollar was only in the market for about 6 months. By year end, you might have around $12,300. That is an $800 difference, and we are only talking about 1 year. The gap compounds over time. Now, to be fair, this assumes the market was relatively stable and trending upward, which is historically the most common scenario, but it is not the only scenario. So when does DCA actually win? Situation 1. The market is near an all-time high, and you're about to invest right before a significant correction. If markets drop 30% shortly after you go all in, you would have been better off spreading it out. This is real. Corrections happen. Bear markets happen. Situation 2. You have high loss aversion. This is a behavioral finance concept. If a 20 or 30% drawdown on your portfolio would cause you to panic sell, taking everything out and locking in losses, then you are better off with DCA. A suboptimal strategy you stick to beats an optimal strategy you abandon. Situation 3. Your money arrives in chunks. A bonus, an inheritance, a business sale. You do not always have a lump sum on hand. If your money comes in monthly, you are already doing DCA by definition. Situation 4. You are new to investing. DCA builds a habit, removes the anxiety of timing, and gets you in the game. A beginner who starts DCAing immediately is dramatically ahead of someone who spends 6 months trying to find the right entry point. Here is the thing the math alone cannot capture. The best investment strategy is the one you will actually stick to. Study after study shows that individual investors dramatically underperform the funds they invest in, because they buy high when things are exciting and sell low when things get scary. The fund returned 10%. The average investor in that fund returned 6%. That gap is entirely behavioral. DCA removes the decision. You invest on a schedule, set up an automatic monthly transfer, and you are done. When markets drop, you are still buying. When markets rise, you are still buying. You are not checking the news and second-guessing yourself. That consistency is worth something, not just mathematically, but psychologically. The investor who stays in the market through a 50% drawdown because they did not bet everything on day one is more likely to actually hold through the recovery than someone who watched their entire lump sum immediately decline. Behavioral edge is real. Do not underestimate it. Let me put it all in one place so you can see the full picture. Dollar cost averaging is best for regular income earners investing from a paycheck. It is the math-inferior choice in most scenarios, but it is emotionally easier, automatically builds a habit, and reduces regret risk. It shines in falling or volatile markets. Lump sum investing wins mathematically about 68% of the time. It maximizes time in the market from day one, but it requires emotional discipline to hold through potential near-term volatility. It shines when you have capital available and the market is in a normal or rising environment. Neither strategy is wrong. The worst outcome is the third option, holding cash and waiting for the perfect moment. That moment rarely comes, and every month you wait is another month of missed compounding. Here is a simple framework for deciding which approach is right for you. Start by asking, do you have a lump sum ready to invest right now? If no, you are a DCA investor by default. Set up automatic contributions from your paycheck or bank account. Automate them, and do not overthink it. This is how the vast majority of everyday investors build wealth. If yes, ask yourself honestly, can you handle a 30% drawdown immediately after you invest? Can you watch the number go down significantly and hold anyway? If the answer is no, spread it over 3 to 12 months using DCA. The emotional stability is worth the small mathematical cost. If yes, you can handle volatility. The data supports going all in. Deploy the lump sum, invest immediately in a diversified index fund, and hold. The key insight, this is not purely a math problem. It is a math plus psychology problem. Know yourself. All right, let us close it out. 1. Lump sum investing outperforms DCA approximately 68% of the time over a 12-month period. The data is clear. Time in the market is the primary driver of long-term returns. 2. DCA is not a math winner, but it is a behavior winner. It removes decision fatigue, builds habit, and keeps emotional investors from panic selling. 3. If you are investing from regular income, paycheck to paycheck, you are already DCAing. That is the right move. Keep going. 4. If you receive a windfall, a bonus, an inheritance, a sale, and you have the emotional resilience to hold through volatility, the research supports deploying it as a lump sum. 5. The worst strategy by far is waiting in cash for the perfect time to invest. That moment does not exist. Time in the market beats timing the market every single time over long enough horizons. If you are new here, we cover personal finance and investing like this every Monday, Wednesday, and Friday. Subscribe so you do not miss next week.